House Republicans are set to vote within the hour on the rule for consideration of a mega tax and spending bill. The latest version of President Trump's big, beautiful bill would add nearly $3.3 trillion to the U.S. deficit over the next 10 years, according to the Congressional Budget Office, a far steeper price tag than the House's initial version. That staggering debt load could have big implications for the U.S. economy. Joining me now, we've got Nick Timmeros, who is the chief economics correspondent at the Wall Street Journal. Great to have you here with us, Nick. What does just the tax bill mean here for the Federal Reserve as you've been able to gather your own reporting and have discussions on this?
You know, it's hard to say. It's hard to say how much the tax bill has really entered into their forward-looking forecasts so far. Because when you think about what they're doing here, what the Congress is doing, they are really removing potential headwinds if the tax cuts didn't get extended. Obviously, there's some new tax relief in there. There are, projected higher deficits from the independent budget crunchers. So maybe you're adding a little bit of tailwind to the economy early next year. But it seems like this is really more about taking away headwinds. And so it's not clear how much that's going to change the outlook for the Fed. I would also say it's just awfully hard to sort of separate that from all the other policy experiments that we're running right now. Tariffs, which gets a lot of the attention, but also on immigration, on the cutbacks of the federal workforce and sort of the related contractor, science and tech funding complex. So when the Fed says they're studying kind of all of the policies, it's hard to figure out, well, how much does, this offset that and so forth.
With that in mind, it's never a clear-cut answer that we get from Fed Chair Jay Powell whenever he is asked about the impacts of a tax bill or the committee members' thoughts on the tax bill, and rightly so, as they want to make sure that they are coming across as apolitical and just down the middle as possible, as they are really focusing in on their dual mandate. But then we have to become maybe not concerned, but certainly monitor what trends look like as per their lens as some of these elements of a bill do take effect. How long do we typically see them wait to really show up, to really kind of solidify that a trend has shown up in the data?
Well, that's just it. I think they're just going to have to default to looking at the data because it is so difficult to, weave together all these forecasts. If you go back to 2018, after the initial Trump tax cuts were passed, the transcripts are public from the Fed meetings in 2018. The Fed staff forecast in the Teal Book are public. The Fed staff turned quite hawkish, much more hawkish, in fact, than the committee in 2018, coming into 2018 after that was passed. I think this time is different, again, because you're not creating as many new tax provisions. You're doing extensions of existing policy. And then you just have all this other noise from tariffs, immigration, and DOGE.
And so with that in mind, how significant is it the newest voting members of the FOMC and how they're actually going to be able to play more of a role this year at a time where we are waiting for trade policy negotiations to net out in one way or the other, and then us be able to track what the impact to the consumer front and the stable prices might look like, and what policy decisions they might need to make off the back of that. Is there any significant delta in the thinking of these new voting members versus what we had seen in years past?
Well, I think it's possible that some of the people who have joined the Fed more recently, the people who weren't there for the big 75 basis point increases in 2022, they may be more hawkish. They may see this as, okay, there's inflation risk now from these tariffs, and we really have to be vigilant against that. They weren't there for maybe the mini Volcker moment that the Fed had when they got aggressive on raising rates 3 years ago. But as you look at the committee dynamic right now, I think this is still a committee where, Chair Powell is in control. He tends to get what he wants. That doesn't mean it's always, easy or without dissents. And as we've seen now with Chris Waller and Mickey Bowman coming out for a July cut, I think it raises the odds that you see dissents from here on out, at least in 2025. They don't cut in July. Well, do Waller and Bowman dissent? If they then cut in September, you could have more hawkish committee members who dissent on that. And, in the time that Jay Powell has been chair of the Fed, to my mind, the period with the most disagreement on the committee was, in fact, when they did the 3 mid-cycle adjustment rate cuts in 2019. You had about 5 Fed presidents that summer, 2 of whom were voting, that did not think it was appropriate to be lowering rates. And then you had 1 Fed president who was dissenting because Jim Bullard, the then St. Louis Fed, wanted a more aggressive path down. So I think it's, you're going to see more sort of palace intrigue, both with the president being quite vicious towards the Fed and demanding rate cuts, but also a committee that will not be of one mind over how to deal with this, unless the data is just blindingly obvious, begins to break all in one direction or the other.
With that in mind, we're going to get a key data point in the employment situation from the Bureau of Labor Statistics. What are the anticipations, especially as the setup has not been good for some of the precursory data, both in the layoffs data from Challenger that we were just discussing not too long ago. It's the highest total, Q2 total, since 2020 that we've seen. And then additionally, ADP private payrolls, that was down 33,000. So 33,000 jobs lost versus the addition that was expected of about 98,000 jobs there.
So a couple things I think about. One is that, the Fed participants this year have been talking about, they've been talking since last year really, that they expect the break-even pace of job growth to come down. It went up when we had a huge increase in immigration after the end of the pandemic. It's going down now. The Biden administration did cinch up the border last year, and now the Trump administration is doing much more public raids and deportations, and you're hearing about Hispanic worker absenteeism. And so, there's a report out today from economists at Brookings and AEI who say the break-even pace of job growth could be below 40,000. So you could see, job growth at 50,000 a month and potentially not have the unemployment rate going up. I'm not predicting that, but other people are saying that's possible. And I think the Fed has already taken that on board, that you could see that. It'll feel uncomfortable to see job growth slowing, just as it felt uncomfortable last year to see the unemployment rate creeping up. But it's going to be very hard to gauge underlying labor demand. And then the other point I would make is that it's unusual that you would see the Fed completely change what it's doing on the basis of one report. The big policy pivots that we've seen from the Powell Fed, sometimes it looks like they're doing it on the basis of one report, but it's usually revisions to past month's data. So you get a benchmark revision that says, hey, not only was job growth slower last month, but it was slower for the 6 months before that. You've seen the same thing when inflation data got revised in early 2023, and they sort of toggled from doing 25 basis point hikes to putting a 50 on the table before the SVB collapse. And so it's really just, one report might catch their attention, but what I think has really caught their attention have been a string of releases or revisions that say, hey, the whole trend looks different. And right now, the Fed has been talking about a low hire, low fire economy, and the numbers this morning, they really seem consistent with that.
Yeah, well, in the previous print, we certainly did get, to your point, some of those significant revisions that ultimately combined for 95,000 lower in the reading for March and April combined here, and we will see exactly, to your point, what those revisions look like come tomorrow, if any. Nick, thank you so much.
Thanks for having me.
Federal Reserve Chair Jerome Powell, speaking in Portugal on Tuesday, told a gathering held by the European Central Bank that the U.S. Central Bank may have changed their plans for the fight against inflation, if not for the president's trade deals. Yahoo Finance's Jennifer Schonberger has more.
Hey there, Josh. Fed Chair Jay Powell didn't take a rate cut off the table for the Fed's next policy meeting later this month. And as you said that if it weren't for tariffs, the Fed would already be cutting rates. Listen.
And on the data, and we are going meeting by meeting. I mentioned how I'm thinking about that, but I wouldn't take any meeting off the table or put it directly on the table. It's going to depend on how the data evolve.
Powell noted that a, quote, solid majority of the Fed's interest rate setting committee thinks it will be appropriate to begin lowering interest rates at some point later this year, explicitly saying in the remaining 4 interest rate setting meetings, which would include the next meeting in July. When asked if the Fed would begin already cutting rates had it not been for tariffs, Powell had this to say.
I think that's right. In effect, we went on hold when we saw the size of the tariffs, and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs.
Powell reiterated that the Fed has not seen much of an impact yet from tariffs on inflation, noting that the central bank expects to see, quote, some higher readings on inflation, but that officials are prepared to learn and that inflation could be higher, lower, later, or sooner than expected. Powell has roughly 10 months left in his term as chair. And when asked what keeps him awake at night, he says he wants to turn over an economy to a successor that is in good shape. Asked whether he would remain on as a Fed governor after his term ends as Fed chair next May, Powell said, I don't have an answer for you today. Josh?
Thank you, Jen.
Well, job openings increasing unexpectedly in May, rising to a 6-month high at nearly 7.8 million openings, suggesting more confidence in the labor market ahead of Thursday's jobs report. While U.S. manufacturing remains somewhat sluggish in June, suggesting President Trump's tariffs are having an impact on business. Manufacturing PMI rising to 49. So, some improvement from the prior month, but we're still seeing that gauge below the 50 mark, indicating contraction. So here to discuss what it all means for the U.S. economy, we've got Paul Grunwald, who is the S&P Global Ratings Global Chief Economist here. Thanks so much for joining us on
Good
set
to be
today.
back.
Absolutely. Also with us for the conversation, we still have Steve Sosnick of Interactive Brokers. So as we really think through the data that we've seen come through and whether or not it's starting to line up in a trend fashion that would then pivot the Fed or at least get them firmly into cut camp, are we close, or how many data points away from making that trend are we in your region?
Yeah, we think July's probably too early for the Fed to make its next cut. They'd have to see some bad employment numbers and then some weaker inflation numbers. And our baseline's still got this gradual slowdown in the U.S. this year, but we don't think they're going to be ready to flip the switch in July, at least what we've seen the last couple of months. But as this morning's data show, we're still a little bit in this bouncy area where things are a bit all over the place.
So Steve, does that set us up for September then?
It could, assuming that we know what's going on in terms of tariffs and we know what the budget effects of the deal are going to be. It sounds like certain members of the board are a little trigger happy. Others are not. Powell seems not to be. Bostic's not voting, I think, this time, but he seems not to be. So there's mixed commentary. Again, as I mentioned, the market tends to get ahead of the Fed a bit. But I'll leave the real underlying economics to Paul.
And when we think about those underlying economics right now, where is the Fed seeing the most area of concern at this juncture, especially as they're hearing from everyone from President Trump chirping at Fed Chair Jerome Powell, all the way through to some of the major investment institutions that are saying, okay, yeah, now we're starting to think that they should be cutting as of.
Yeah, well, the big issue is the uncertainty. It's not, as we've said, it's not really the tariffs themselves. Those are a negative issue, but it's really all the uncertainty around tariffs. We've got another date coming up on July 9th, which is the pause on the April 2nd tariffs, and we just don't know what's going on. And when people don't know what they're going on, they slow down investment, they slow down spending, they slow down capital allocation, they slow down M&A. So we've still got this overhang on the market, and we'll see what happens on July 9th. We heard some noise about Japan this morning, but as long as that overhang is there, we still think we've got to sort of dampen sentiment everywhere, basically.
I want to stick with you for a second, Paul, because I was taking a look at one of the notes from Apollo chief economist Torsten Slok this week. It said when FOMC members produce their forecasts ahead of Fed meetings, they are also asked how they view the risks to inflation and unemployment. And one of the net takeaways that this is a Fed that is worried about stagflation right now.
Yeah.
Why is stagflation now one of the core worries for the Fed, and to what extent are we placing probability around the reality of stagflation playing out?
Yeah, we're not really in the stagflation camp. We are going to get a rise in inflation rates because the tariff's going to lift the price level, but that's not really a driving force on inflation higher. So I think we're still in this kind of traditional world. The signals are very noisy, right? Because you are going to get a rise in inflation and a rise in unemployment, and that's kind of stagflation. But we think we're going to look through, and the Fed's probably going to look through the jumps from the tariff versus any underlying inflation trends. We still think the next rate's down.
How can investors position their portfolio if we did see stagflation play out? What are perhaps the stagflation positioning in a portfolio?
Stagflation is kind of like the worst of all scenarios.
Yeah.
Now, I'm with Paul. I think technically, if you're looking at higher prices and a slowing and a stagnant economy, that's stagflation. But I think when the term gets thrown around, we're nowhere close to what true like 70s style stagflation is. And correct me.
Can I jump in on the back of that? And the other thing we're seeing now, the positive thing that we didn't see in the 70s is productivity growth. Remember, the last couple of years, U.S. has been hitting the ball out of the park relative to the rest of its peer group. Strong productivity growth, strong new business formation. So that's not a recipe for sort of supply side, weakness. That's really a stagflation issue. So I don't think that's really on the table right now.
You talk about that productivity growth, and one of the questions that we've had for several jobs readings now, perhaps for a couple dozen, is where we might see AI start to show up within that productivity growth as well.
Yeah, that's kind of a big, even economists, even really smart economists, have got this huge range of outcomes, right? The current Nobel laureate's close to zero for the effect of AI on growth.
Interesting.
Some of the more, bullish guys on the street are 1.5% increase in growth over 5 years. Some of the, the IMF, OECD are in the middle. We just don't know. We know it's positive. We don't know when it's going to show up in the data and for how long it's going to last. But it's got some potential. I wouldn't be watching kind of the month-to-month, labor market data to see if we're going to see AI. I think it's just a longer-term kind of trend thing, but definitely positive.
Even if positive for productivity, is it still positive for overall headline jobs growth?
Yeah, well, that's the thing. You can have productivity go up by hiring fewer people or expanding the pie and hiring more people. So that's the big thing with the AI. Productivity is going to go up, but is it labor enhancing or labor substituting? It's probably going to be a little bit of both. We're going to have to tease those out. But again, that's a multi-year thing. That's not we're not going to know the answer to that by the end of 2025, right?
Look, we just want to know all the answers all the time.
I know.
That's why
I'm sorry to disappoint you, Brad.
Paul, great to have you here. Never a disappointment at all here. Thank you so much for joining us in the studio.
President Trump could be getting closer to naming the successor who will replace Jerome Powell as Federal Reserve Chair. Yahoo Finance's Jennifer Schonberger joins us now with the latest. Jen.
Good afternoon, Josh. President Trump's desire to replace Fed Chair Jay Powell is reaching fever pitch. Furious over the Fed's wait-and-see slow-walk approach to cutting interest rates, President Trump is considering announcing a new Fed chair pick early to undermine current Fed Chair Jay Powell, whose term does not end until next May. Trump told reporters on Wednesday he's narrowed it down to 3 or 4 candidates, and 2 people close to the administration tell me the president could make an announcement soon. Here's a look at a short list of those potential candidates. Topping that list is Kevin Warsh, a former Fed governor from 2006 until 2011. He said in a Wall Street Journal op-ed earlier this year that he believes any inflation from tariffs would be of a smaller magnitude and that he would look through them as a one-off price change. He thinks inflationary effects from larger tariffs are also overstated. Next up is Chris Waller, a current Fed governor who has said that he could see cutting rates as soon as the next policy meeting in July. Waller says he believes any inflation from tariffs will not be longer lasting and supports looking through any tariffs to set rates, a view that is in line with the White House. Then we have Treasury Secretary Scott Bessent. He told House lawmakers earlier this month that he'd like to stay in his seat until his term ends to carry out the administration's agenda, but he hasn't dismissed the possibility of being the next Fed chair. Bessent has largely stayed out of voicing his opinion on monetary policy, as any Treasury Secretary would, only saying that the administration is looking to bring down bond yields, which influence interest rates. Through pro-growth policies like tax cuts, deregulation, and trade negotiations, he has refuted the notion that tariffs could lead to any persistent inflation. We also have Kevin Hassett. He's a trained economist and currently director of the National Economic Council, which advises the president on economic policy. And he has said there is no reason that the Fed should not be cutting rates right now. And rounding out that list is David Malpass, a former president of the World Bank, who reportedly says the Fed needs to look towards setting the groundwork to cut rates to boost growth, noting that the Fed's forecast for growth this year is low. Now, Josh, I am getting actually conflicting information from multiple sources on potential candidates on this short list. A longtime economic aide to the president, Steve Moore, told me earlier today that Waller may not actually be in the running because he was not in favor of cutting rates at the Fed's last policy meeting. At the same time, another person close to the administration says that Kevin Warsh, who had been at the very top of the list in the running for the president for months now, is one that the president has soured on. A senior White House official telling me that no decision is imminent and the president has the right to change his mind.
All right,
a little bit of flexibility there.
The drama continues. Thank you, Jen.
Yes.
Appreciate it.
Well, Federal Reserve officials are split on whether an interest rate cut in July is on the table. Depending on whether the FOMC holds rates steady or reduces the benchmark rate, what does that outcome mean for your everyday finances? Here to explain and discuss further, we've got Rob Conzo, who is the Wealth Alliance CEO. Rob, good to have you here with us. How does the Fed's benchmark rate affect people's personal finances?
Great to be with you, Brad. It's a very misunderstood rate. It's the rate that banks charge each other to borrow money, but how does that affect you personally? Well, first thing, it affects you either way. Number one, on the expense side, meaning borrowing. So we all know that, right? We have mortgages and credit cards and auto loans and student loans and small business loans. So when the Fed sets a rate, right now it's between 4.25% and 4.5%, well then all the banks look at that rate and decide where they're going to charge you for the debt side of it, your expense. And let's not forget, half of the American economy is small business. So when they have to pay more for lines of credit and loans, well, it hurts them, they hire less, and it's a problem for the economy. So that's why everybody wants the Fed to lower rates.
So, Rob, let's get specific. How are mortgage rates impacted by the Fed's next move? And does a cut mean that we could see lower mortgage rates as well?
Yeah. So the longer you go out with lending, the longer other factors are involved. I'll give you an example. Let's talk about money markets. That's money you're earning. Well, that's every single day, and all that matters is what the Fed is going to charge and what the bank wants to make. And there's a rate. A mortgage, money, expense you're spending. Well, that's different. Now suddenly the bank goes, all right, let's see what the Fed is going to charge, 4.25%. Okay, now you want to get a mortgage. So the Fed rate is one aspect. How much of a mortgage is the second. How long are you going out? What's your salary? How the house is valued at. So the longer the debt, the more Fed rates, the more your personal stuff gets involved and muddies the water between just the Fed rate. So the Fed rate is just a little part of it when you're going out longer.
You know, while we have you here, now let's go to credit cards. Say, maybe not me, but somebody I know has a lot of debt and racked up here. Will a lower benchmark rate from the Fed mean that I have to pay less interest, perhaps?
Great question. The credit card one is the one that's a little unique in the sense that credit card companies charge upwards of 15, 20, 25% in interest. And you're saying to yourself, well, how could it be so high? And it's so high because credit card companies want to make a lot of money. So at the end of the day, there's so much leeway in the credit card company. You would think if the Fed lowered rates, you would see credit card rates come in as well. That may not be the case. Some credit card companies just hold it steady. And it is what it is. I'll give you another example. Sometimes, forget credit cards, again, when you had a bank savings account and you're getting very, very little interest rate, but yet the the Fed's rate's at 4.25, 4.50. Why is that the case? The bank has the right to say, look, we're only going to give you 0.2%. Meanwhile, another brokerage account could give you 4% on a money market. So there is business parts of what the interest rate you pay or you receive on top of the Fed rate mandated.
What about savings vehicles like CDs, certificates of deposit? How are they impacted depending upon the Fed's decision?
So CDs, savings vehicles of all sorts, money markets is a standard one, bank savings accounts, people know. Again, there's two aspects of it. Fed, surely, if the Fed raises rates like they have, well, then you're going to typically get more in bank savings accounts and CDs. And we've seen that. People getting 5% in CDs. The Fed starts lowering rates if they do, and we don't think they're going to be doing that this July, but a good chance they could be doing that in September. The Fed starts lowering rates, you'll see those CD rates and savings rates come in. And that's why a lot of financial advisors are saying, hey, you may want to lock in a longer rate now while it's still high before the Fed cuts.
And finally, while we have you here, Rob, when the Fed finally cuts interest rates, should you adjust should you adjust your financial plans, things like your budget or borrowing, or should you just stay the course?
Now, it's a very good question, and it depends, really. And a lot of answers to financial questions are, it depends, unfortunately. But the real answer is, when the Fed starts cutting rates, if it's just very, very minimal, a quarter of a point, that's not going to make a big difference on things. But as things start to go down further, if they do, well, then you want to start preparing for that now. You want to get your financial plan in order, understand how long your debt is going out. Are they credit cards with really high interest rates? And on the income side, are my income vehicles, bonds, CDs, savings accounts, giving me the interest that I need to make my retirement and financial goals?
Rob, thanks so much for taking the time here. We're going to be watching closely, as we know that you will be too, for when they do start to cut interest rates. Thanks so much.
All right. Thank you.
Ben, I'm going to hit you up first because you are our resident Fed watcher here. What exactly would a shadow Fed chair, first of all, what is it? And have we seen it before in the history of the Fed?
The shadow Fed chair, Brian, is someone who basically takes the position of the chair and communicates quite openly about policy, what she or he thinks policy should be at and go forward from here, without actually having the voting authority on the FOMC. And yet people will pay attention to this person because, as it is the incoming chair, it already is shaping our policy where it will be in the future. And markets are always about discounting the future, right? So that's, I think, what the shadow Fed chair could do, really affect expectations.
Ben, let me get in here real quick, Ben. Who should investors listen to? A month from now, let's say we get Christopher Waller. I mean, who should that long-only investor listen to? Things that Jerome Powell says as he winds down, the last 8, 9, 10, 11 months of his term? Or Christopher Waller, who might be out there doing an interview somewhere suggesting we need rate cuts?
The market's already listening to Chris Waller, Brian. I mean, they basically start pricing in this rate cut a bit sooner than what was before, partly because of his comments. And people pay more attention likely to Chris than to Jerome Powell, for that matter, knowing he's going to be out. The moment you announce this new candidate, that's exactly the process that will start playing out in the markets. It will take the shadow chair more seriously than the current chair, for that matter, in terms of future policy. But has this happened before in Fed history? Well, take Alan Greenspan. He came out of the administration. He was sort of pre-announced initially, but that was a different time. So I think this is quite unique what we're dealing with here in terms of where we go from here. Nonetheless, we're going to see a new chair in the future. So policy will shape itself that way. And if inflation continues to moderate, the market will continue to price in deeper rate cuts.
Ben, I still remember those Alan Greenspan testimonies. Had no clue what the hell the guy was even talking about. He just sounded really smart. Inez, let me get over to you because I know you're watching oil, various commodities. You're also locked in on all things crypto. Ben made a really good point that perhaps this market is already taking a cue from someone like a Christopher Waller, who's been out here recently suggesting we need rate cuts. I even look at the move in palladium. These are metals potentially moving in front of a more inflationary environment if we get rate cuts.
Yeah, that's right. The metals have been moving and gold has been moving. I mean, you have to look at what has happened in the market so far this year, and that is investors have flocked to gold. They have gone towards Bitcoin. They have gone towards other assets. And we have seen the Sell America trade earlier this year. Look, I will say one thing about this issue of whether Trump says who he wants as Fed chair early or not. There are some in the market that feel that when the whole tariff situation was going down, which, by the way, that's coming up again, that when that was happening, the fact that Powell remained steady actually helped the bond markets, because we saw the 10-year rising and we saw the sort of issues that were starting to happen in the bond market. So the fact that Powell stayed steady, that there wasn't this influence that we've seen in emerging market style countries that we've seen in other countries. There are analysts that feel that it was a good move for him to stay steady. So it'll be interesting what happens if Trump does name who he wants as the next Fed chair early, to see what happens in the bond market as well and how the market reacts overall.
No, good point, Inez. I should also mention, too, that Wall Street Journal report mentions Kevin Walsh, who hasn't been in government for 15, 16 years, Christopher Waller, Fed Governor, Treasury Secretary Scott Bessent, and of course Kevin Hassett, a friend of or no stranger to Yahoo Finance. But Al, you're watching markets quite closely. I mean, just picking up what Ben was saying, the markets. I always hate saying the markets feel. Markets feel nothing. They trade on numbers and various plumbing in the system. But still, this is a market that seems to be moving on the fact that we do get some rate cuts.
Right, and I do think if we see a cut, especially if we have some sort of a surprise cut in July, markets are going to react to that and we could see a pop. I've been thinking, though, what if we cut for bad news and not good news? Would we still see that type of reaction in stocks? And right now, markets are pricing in a rate cut in September. However, the odds of a July rate cut, that's edged up a little bit. Now, Jerome Powell, during his two-day testimony, he said that we would maybe consider a cut in July if the labor market deteriorates. I don't see that happening at this point. Continuing claims, continuing to edge higher today, but the unemployment rate is still solid. There is this sentiment among businesses that they don't want to fire at this point because past economic downturns, past recessions have taught us that it's really hard to rehire that talent back. So we're seeing businesses be steady right now. We're in this low hire, low fire environment. So as long as the economy holds up okay in the interim, I don't think we are going to see any type of rate cut in July, despite the president obviously wanting that at this point. But even after this Wall Street Journal report, markets not totally reacting here. I mean, we're seeing stocks edge higher today. There is this optimism overall in the markets right now. Tech is certainly leading the way higher there. So we'll just have to wait and see what ultimately comes out of this and who the president decides to go with.
Policy changes continue to evolve and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that would depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance.
Fed Chair Jerome Powell resumed his two-day congressional testimony today in front of the Senate. Yahoo Finance's Jen Schonberger joins us now with more. Jen.
Hey, Josh. Fed Chair Jay Powell reiterated his wait-and-see approach to Senate lawmakers this morning as he waits to see whether tariffs impact inflation over the summer months. Some Republicans took Powell to task for suggesting that tariffs would lead to higher inflation.
Inflation in America is down. We got elected by millions of voters. You got elected by one person. He doesn't want you to be in that job. And you are costing this government $400 billion a year by refusing to lower interest rates.
And that one person, President Donald Trump, has continued to publicly hammer Powell and the rest of the Federal Reserve for not lowering rates. Now, back on Capitol Hill, while Powell was testifying 38,000 miles away in the Netherlands, Trump told reporters that he's actively considering replacements for Powell, but didn't offer specific names.
I know within 3 or 4 people who I'm going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible.
This comes after the president posited just last week that maybe he should reconsider his plans for firing Powell, only to say that his term does end shortly. Powell's term ends in May 2026. Meanwhile, Republicans pressed Powell for clarity over what they called billions of dollars in lavish renovations for the Fed's 2 office buildings here in Washington, D.C., with reports alleging that new elevators are being put in with direct lines to private dining suites and private garden rooftop terraces.
I would also say that the media reports that you accurately quoted, they're misleading and inaccurate in many, many respects. And I would just point to, there's no VPI dining room. There's no new marble. We took down the old marble, we're putting it back up. We'll have to use new marble where some of the old marble broke, but there's no new, there are no special elevators. They're old elevators that have been there. There are no new water features. There's no beehives, and there's no roof terrace gardens.
For the economy to avoid persistent inflation, do you concur with Governor Waller that there is a pathway for good news as it relates to the regulatory policies, the tax policies that I've discussed in a world with lower tariff rates?
So first, I wouldn't comment on any other FOMC members' comments one way or the other, but I will say this. I think many paths are possible here, and certainly the one you mentioned is a possible one. We could see inflation come in not as strong as we expect, and if that were the case, that would tend to suggest cutting sooner. We could see the labor market weakening, and that would also suggest cutting sooner. On the other hand, if we see inflation coming in higher, or if the labor market were to remain strong, then we would probably be moving later. So I think a range of possible paths are possible, and certainly the one you mentioned is one of them.
In February of 2021, you told us in this committee that you would stay in your lane and not comment on President Biden's proposal for the American Rescue Plan or sharply increasing federal spending. And you said it was an issue, but that you would stay in your lane and not comment on it. But here in this year, you have commented on this idea of tariffs being set by the executive branch. So are tariffs in your lane, but a huge fiscal spending by the Biden administration not in your lane? Explain to the committee why you chose to be silent in February of 21, but outspoken this spring.
Sure. So we haven't commented, and it would be inappropriate for us to comment on the policy of tariffs. We don't have a view. It's not our job, and we just wouldn't do that. And just as we wouldn't comment on the reconciliation package that you're working on right now. We're not commenting on tariffs. What our job is inflation, keeping inflation under control, and also keeping maximum employment. And when policies have what appear to be short and medium term implications, meaningful implications for that, then they kind of, not the policies themselves, but the inflation becomes our job.
Drew and I want to start with your thoughts on the Fed and Powell's comments today. What do you think?
Well, we've been hearing the same sort of thing from Jay Powell. There wasn't really anything new in his commentary today. He has been talking about patience. What's different is the backdrop for his comments today, in the sense that we are hearing some of the other Fed officials start to say maybe we should be cutting by now, expressing some concern about the labor market, or at least a more attentive eye to the labor market. There still seems to be pretty broad agreement that we could see some kind of tariff-related surge in prices over the summer. The question is, how long does that last? How big is it? How entrenched is it? And then how should that inform what the Fed is doing? But there are still certainly plenty of Fed officials who are still in Jerome Powell's camp as well, who think that we could see, that there is no harm in waiting, I should say, to see what happens with the effect from the tariffs making its way through the economy, Josh.
Good point, Julie. Chris, I want to get your thoughts on the Fed here as well. There was one line, Chris, when Powell's getting grilled today. Jen brought this up. I just wonder if this maybe kind of perked investors' ears and attention a bit when he said, if it turns out that inflation pressures do remain contained, then we will get to a place where we cut rates sooner rather than later. What'd you make of that, Chris?
That is certainly a dovish comment, Josh, and I think the market likes to hear that. But at the same time, we have to understand that Powell is going to focus on the data. The FOMC is going to focus on the data. And what was the most recent piece of data that we got? Yesterday's flash June PMI report from S&P Global. What did it show, unfortunately? Inflation ticking higher, manufacturing and services parts of the economy, input costs, output costs, and businesses pushing more price increases onto consumers because of tariffs. So that's not constructive for any dovish comment. And I think next week, when we get a sea of June data from ISM, ADP, and others, we're going to have a lot more information. And if it backs up what the flash PMI report had to say, I think folks are going to start thinking maybe September, but certainly not July.
What about, Chris, this idea, and Jen brought this up, and it's a good point. President Trump is not happy. He's not happy with the Fed. He's not happy with Jay Powell. He's calling the Fed head names. He's arguing, you are late. You are late already. You should be cutting now. What do you make of that?
Well, again, if you take a look at the data, the inflation data in particular that I just mentioned, and you look at the employment numbers that we saw in the flash June PMI report that actually grew month over month in manufacturing, services still continuing to increase as well, there is job creation. I don't think until you see a real softening in the jobs market, maybe even a month of negative job losses, that that part of the equation is going to push the Fed. But I will tell you though, I do think that when we see the Doge-related packages expire in September in September and into October, that could be when we start to see a real softening in the employment market. That could get the Fed to move.
It is good to see you, John. I want to start here, which is you say, listen, okay, and I think Powell made it clear today again, John, on Capitol Hill, they are comfortable sitting on their hands for now, staying on hold. But you say maybe they're on hold for even longer than some folks think. Why do you say that?
Well, I just think that Powell, and he reiterated this today, he's going to want to see the data and make sure inflation expectations don't get embedded. I just go back to we've been in an inflationary regime now for a couple of years, and there's been a lot of excuses around it. First, it was supply chain and all the fiscal stimulus that was supplied during COVID, and they were late to the game then. And I don't think he wants to see those inflation expectations get embedded if we do see inflation come through from tariffs. And the other point on that is he's in a place to wait and see as well. Unemployment remains relatively low at this point. And if you look at where GDP estimates are for Q2, they're pretty robust. GDP now is in the mid threes. And so the economy appears really strong and gives them the time to wait.
What about President Trump's comments, John, that he thinks they're late already, they should be cutting now?
Well, I think Powell did a good job answering that question and said, they're focused on their dual mandate, right? I think he's going to ignore the political background noise that's provided, from Donald Trump and focus on the job that he has at hand. So I don't think that's affecting his how he views rate cuts in the future.
And what is your base case, John? How many cuts would you expect to see this year from the Fed?
I still think we'll see cuts, but I think it's going to be, I think the earliest we'll see a cut is in September. In my view, we're going to have to see how the tariff data plays out, and that's going to take a while to flow through. We're going to have to see it flow through the inventories that were pre-bought and how companies are raising prices. And so to me, it looks like September would be the earliest. The other thing I'll say, we have roughly 2.5 cuts priced into the market this year. And some of that is the market's ahead of where the Fed is at 2 cuts. And some of that, I think, is the scare on the unemployment side actually getting worse. We can think about tariffs as a tax and a tax on the economy. And so there is this potential chance of a larger than expected slowdown in which the Fed would actually have to cut more towards the end of the year.
What is the Janice Henderson kind of base case, John, for the U.S. economy, and how you all over there see it evolving over 2025?
Yeah, the fixed income markets are in a really good place right now, and you know the key word that everyone's talking about is uncertainty, and the great thing about where we are in the cycle is we have pretty high rates today, and credit spreads give you a fair amount of cushion for all these different scenarios that play out. So our base case is, tariffs increase inflation. It's a one-time increase. The economy still it probably grows below trend, but still positive growth, which once again is a great place for the credit markets. I run a multi-sector income fund where our yield is over 7%, and so we have a lot of cushion in there to provide that any type of kind of downside case if spreads widen out or rates rates go wider from here, and upside if spreads tighten and rates rally.
Well, why do you say, John, I'm curious, you prefer securitized credit here to corporate credit?
Yeah, we've been overweight securitized credit, and the reason why is corporate credit, there's still a lot of value in corporate credit, but it's on the tighter end of the spectrum today. If you look at where high yield and investment grade corporate spreads are trading on a 10-year look-back period, they're hovering right about the 10th percentile. So they're still not near the tights we saw earlier in the year, which gives you a little bit of a cushion, recent cushion, but they're still very tight compared to history. If you look at the securitized side or even agency mortgages, they're closer to fair value. And so our view is you want to be able to move around in the fixed income markets, find where the value is, and protect on the downside. So we've been overweight securitized credit. And we also think that you're getting more yield per unit of volatility in the securitized space today.
John, great to see you. Great to have you on the show today. Thanks so much. Appreciate it.
Thanks for having me.